That makes no sense. It's just like why we in our office and most advisors should, you look at a 5-year period, a 10-year period. You don't look at even just one. I can give 100 examples of over the last 25, 30 years where I have seen people, and I think about the Florida, the oil spill, and what happened there, and the companies that were doing well, and then the next year everybody thought they were going out of business because there was reasons for that, like in Arizona or Las Vegas, when the housing, prices of housing, 130% increases. Well, darn, they dropped about 40%, 50. Well, so what? If you look, just average the 2 years. So you really have to be smart about that and not allow an emotional,
that's right.
Anything that happens quickly, you're just like, okay, wait a second, let me think about this. Better yet, pick up the phone and say, Damon, what do you think about this? That's the best thing to do.
Right, yeah.
Corporate earnings are still strong. They are, and they're going to continue to be. Interest rates will still be low even when they increase.
Yeah, relative to the
past
history and what we've seen.
Exactly.
And the thing you have to remember.
Do you remember when interest rates were 24%?
Well, I was very young.
You were not even born.
I was probably still about 5 or 6 years old at the time.
Yes.
But
that was painful, people. Very painful.
Many of our clients talk about it. My mom and dad were thrilled when they got a mortgage in 1975 at, I think, 18%, because it wasn't 20%,
It wasn't 24%. We remember those days.
Right.
It was tough then. But even with all this volatility we've seen, in the market is going to do what the market does.
Right.
And you just have to be smart about it. And as we always talk about it, have a plan in place. When things happen, I can tell you right now, we're doing this webinar. If the market dropped 800 points, because it happened one day.
Oh, it's happened several days here in the last year.
Exactly.
We've seen those kind of volatile swings.
Yeah. And how many phone calls do we get? Slim to none.
Maybe one.
One
or two in the last year.
Yeah.
As it relates to those big declines in the market.
But it's because they know you have a plan. And as long as your plan is working for you, it doesn't matter really what's going on in the world.
Right.
That's why the plan is so important, and the discipline to execute that plan and not do stupid. Damon, when the financial crisis happened, I tell this story because I still see this guy driving up in his car, because it happened to so many people. He drove up in my driveway, and he's shaking his head. He's just pathetic, and I feel so bad for him. And he had this really cool black Corvette. He looked really cool. He was dressed to the nines, and this black Corvette drives up. And I didn't know who it was because his head was down and on. Then I realized who it was, and he just shook his head and saying, I pushed the button, and anybody back then knew what that meant, because we have access to our accounts now. And what he meant is that when the market went down, he got so scared that he pushed the button. Well, you can't come back from that necessarily very quickly. So if you have the right plan, it's always to weather any kind of a storm out there.
Right.
And when you have lived through them, like I have, any kind of a storm out there, the tech bubble, the energy crisis, the oil spill, everything that the world is coming to an end. One day, I get this phone call from a more than one TV station, but, oh, Victoria, we got to come over. We got this China crisis and all. And I was like, China crisis? What are they talking about? I had to go find out what they were talking about. Found out in about 30 seconds what the major breaking news was. And it was really nothing. But it was a good news story. So,
yeah. Well,
and it was good for me because no clients were calling. They're not worried about what was going on in China. And it was all about China was going to start taxing. They were talking about taxing the investments. That's what happened.
Yeah.
And I went, oh, I can talk about that. That's it. It may happen, it may not, but this is an isolated situation, and it hasn't even happened yet. And people were overreacting. So there you go.
The important thing to remember, we deal with retirement. Okay. Now we do have clients that are still several years away from retirement. Well, one of them,
their 40s.
Yeah, or their early 50s, and they still have 10, 15 years that they want to work. But here's the thing to remember about retirement.
They're like me, 20, 30, 40,
You're never going to retire?
Never.
Never going to retire.
Never.
We'll walk in there one day and she'll just be, and well, she went the way she wanted to go.
That's right. Either there in my office or on the golf course.
That's right.
One of the two.
But when you think about your retirement, there's so much emphasis and attention given to the Dow Jones Industrial Index, the S&P, the Russell 3000. Pick your favorite index. And those are important measures and barometers of, okay, how is my portfolio performing relative to that? But when you get into retirement, keep in mind, you will sleep a lot better at night when you remember that retirement is not about beating the stock market. Retirement is about not running out of money. And
what is the name of the radio show?
it's all about the money,
honey. Okay.
And when
Just
you
make sure we're all on the same page.
when you put your focus on your specific income plan, and
Right.
we've got an income plan, and it shows that you've got over a 90% probability of not running out of money until you get into your 90s, and all you need to get is a 6, maybe 7% return over that time, which is fairly moderate over long. I mean,
Well,
that
you're
should
talking
be
about 30 years.
that should be doable, you know.
In over a 30-year period, I
That's
would
right.
sure hope so.
And you begin to see, oh, I don't need double-digit returns. I'll take them when I can get them.
Absolutely.
But I don't have to have it. And so when we have these very volatile swings in the market, you're not freaking out and panicking, saying, oh, I got to go to cash, or, you know, because what should we do? Sometimes, especially if you've got a plan, you don't do anything.
Exactly.
You know, there's nothing to do.
But you continue to monitor it. It's
Well,
yeah, it's never what you're saying, Davis. It's never, oh, we put a plan together and just sit there. Like I said, in our process, once you become a client, it's all about the monitoring of your account and making sure. Doesn't mean that we're not going to make some changes when life happens. We've had several clients that, you know, their spouse has passed away. Well, when that happens, then maybe we need adjustment in either your risk tolerance maybe has gone up or gone down. More importantly, if you've lost income from that spouse. So you have to look at everything that has to do with how life changes. And we around here will say, well, life happens. And that's it. I mean, when something happens, it's a life change. Life is going to happen. So as long as you have a good plan, and when you come in and you discover really what it is that you want to see at the end of the rainbow, what you want and how you want to live, that's the decision-making process. Is that you discover by asking questions, probing. Discovery gives clarification. In clarification, then, like, okay, I'm now clear on my discovery. I'm clear on my goals, my vision, the way I see my life, what I want out of working all these years, and how I want to live in retirement. Then you come down to now I'm coming to the next stage, and that stage is, I need to see all my solutions. What is going to help me best get there? And that's where we help you with different products, solutions, strategies, strategists, and we help you decide who's going to best help me get to where I want to go. And then once you decide, okay, these are my solutions, I agree on them, I have an investment policy statement, says this is how I'm going to manage my money. Then you go into the implementation stage. And once all your accounts are implemented, you've got the whole plan in place, you've got your action plan done, that's when you go into the monitoring. And that usually takes about 45 days to make all of that really happen. Right. I think it's so cute when people come in, it's just like, here, Victoria, take this, I'll come back later, and you just fix it for me. I have a little problem here. I've made a mess of and I joke with people and say, listen, there is nothing so bad, because people have been embarrassed. There's nothing you have messed up so badly that I haven't seen before. I can guarantee you that. And it's not something that can't be with a few things tweaking to get you where you need to be on the right path. Even the guy that pushed the button, even the guy that came in here and showed me he had a 50%, I can't ever say his name because he's high profile out there, but had a 50% loss when the market went down. Everybody was dying when it went down 36.99%. And here he had lost over 50 and said, please, I'm going to give this to you. I should have let you handle this. I have messed this up. I will stay here as long. I'll sign anything. Just fix this for me in 5 years.
Yeah.
And I said,
easy.
5 years?
Easy.
No. So anyway, all right, Damon, on to the next.
Yeah, well,
I
do, but I have one more slide to share too. So
okay.
Now,
is this your favorite slide?
It is my favorite slide because it's important.
We all know Damon loves this slide.
It is important that you stay grounded. It is important that you realize that when we have volatile periods like we've had, it's very easy to forget the long period before that when everything was good. We always focus on the negative. We think about what could go wrong. Where's the next great disaster? even with all the volatility that we've seen so far this year in the market's really only down about 7%. All right. Now you
And
might,
when it's up 27%, 7 is just a little
that's right.
adjustment.
That's normal. That's a normal market, not even a full correction. A correction is described as a 10% decline from a high. Okay. We haven't even gotten there. We got close. I think we got to not minus 9.8% at one point. Okay.
And that lasted how long?
It was like a day.
Exactly.
All right. But here's what I want you to remember. Okay. This happens a lot. All right. So what you're looking at here, I know that this chart here seems really busy, but it's actually pretty simple
It is.
to understand.
When you explain it.
That's right.
The king of finance.
You are looking at from 1980 all the way through 2021 of the S&P 500. Now, the first thing you're going to notice, we've got 42 years of performance of the S&P 500. The first thing you should notice is that in 32 out of the 42 years, the market went up. Only 10 years in 42 did the market go down. Now, there are a couple of big downs in there, okay? We know the 38%, well, that was 2008. Everybody remembers that. But the point to this is, when you look at your portfolio, not at 1 year at a time, but within the context of retirement, which is probably going to be a 30-year period. That bodes pretty well when you take a look at how does the overall market perform and what does that mean for my portfolio, even if I'm at a conservative to moderate risk level. And also notice that even in the years when the market is way up, see the red numbers down below? Those minus numbers represent the lowest or the biggest decline that we saw at any one point in that year. It is not uncommon for the market to have major and many declines, but still end positive. So sometimes the market can fake you out. And if you go and push the button like Victoria was talking about and sell at the first sign of any adversity, that's not a plan. Okay. That is reacting to whatever the market throws at you. And that's when you're going to get in trouble.
Absolutely. And if you really want to understand that, in my book, I talk about the emotional belt. And it's about how people get on a high, and as soon as they get there, and the littlest thing happens, and they get emotional, and they get scared, and they get fearful, and then they push the button, and it really wrecks the plan. So the point is that you really want to make sure that you have a good plan in place first. And I think about this for now, all of our clients that are with us today, our select clients that are here, and the guests mostly, is that what you want to make sure of is that you have that plan in place, and that you don't get emotional, but you do make a phone call. We encourage our clients always to make a phone call. And if if you don't feel like you have the right plan, or more importantly, if you feel like all your money is being managed the same, I always ask this question to people, are you going to manage the money that you need today? Cash. I want to buy that new fur coat at Gino's because it's going bye-bye. He'll be back. But do you want that money managed the same as you do the money you're going to need 25 years from now? Well, the answer should be no. It should be, I want my money managed today much more conservatively. That's why I have cash in the bank. Opportunities may come along. I may want to buy a new car. I may want to client wanted to buy a new $400,000 house yesterday. So, those opportunities come up. So you do have to have cash and liquidity. However, you shouldn't be managing money. So if you're a guest, you should be asking that question.
Yeah. Is all of my money being managed the same way?
As if I'm going to retire at 65 or 66 in 2 months, and I want it all that day. It doesn't happen.
Yeah, you don't. Yeah, I mean, you don't manage money that you need in 2 years the same that you manage money you need in 20 years. It doesn't make any sense. Now,
but I've seen that happen again.
Oh yeah, we see it all the time. And look, if you're doing that, it's okay. It happens all the time. It needs to be fixed. What I'm saying is, don't feel bad.
Yeah,
it does happen. And it happens because for 40 years of your life, you've been accumulating wealth. You've been building assets in your 401k and things like that. And you've probably had it on autopilot a lot of that time. But now it's time to take your aircraft off autopilot, and it's time to fly the plane. And it also means it's time to have a different flight plan whenever you take over the yoke there. Now, I do have one final poll question before we get to the star of the show. All right, so here's the poll question that I'm going to launch in just a second.
Oh, launch it now.
What is your prediction for the market by the end of 2022? So what is your growth prediction for the market by the end of 2022? So I'm going to go ahead.
I was going to say, do we get a price at the end of the year if we get it right?
Well, I don't know. We'll see. Okay, so I'm going to launch the poll right here. So here are your choices. All right. Do you believe that the market is going to end somewhere between a -5 to -10%? Do you believe the market's going to end somewhere between 0 to -5? Do you believe it's going to end 0 to +5? Or we're going to have a really good year and go from anywhere from 5 to +10% growth in the market? So give you a moment to answer this question. And
I think that's a very interesting question. Damon came up with this one. Very interesting question. But I'm very competitive and I do like to win something. It's like I saw a commercial for what is that show? The Brothers?
Property Brothers?
No, this is the one going on. LeBron is on it right now. And he said, he is like, do I get I get a trophy for here? No. LeBron, he does not even understand how the game is played, so it's very comical.
Okay, well, everybody's almost finished answering here. Let's see where we at. Okay, all right. So we've got one clear leader so far. We'll give you just another couple of seconds here to
there
answer.
We go.
So we've got a few more of you that if you want to answer, get it in now. I'm going to give you.
Okay, we don't see your names. We only see.
That's
so
right.
Don't get embarrassed. Everybody.
We're not going to call you out. But
no, we just say the
answer in 5, 4, 3,
Jeopardy.
2, 1. All right, we're going to close the poll right now. Let's go ahead and share the results here. So Victoria, we got most people, 37, 39% believe that we're going to have a pretty modest year, anywhere from 0 to 5% growth. We do have some who see a lot of positivity, 5 to 10% growth. We also have a few that see a somewhat negative year. And so far, the people that have said between -5 and -10, you guys are winning in the clubhouse. You're the leaders in the clubhouse, although we're still on the front 9. Okay, so
definitely on the front 9.
We've got a long way to go before we get there. So well, that's very interesting. Thanks so much for sharing. Well, it's
really all over across the board, really, is what you're saying. It's anybody's game to win.
But when you look at this, we've got what is that? 61% of the people on today actually have a somewhat positive outlook on the market. So that's pretty strong. Okay, and that's kind of been a common sentiment we've seen.
Well, in our strategy meetings with clients, they feel very,
that's right.
And I like that, cautiously optimistic. We should have put that up there. It's like, are you cautiously optimistic? Because so is.
So well, I have the time, and it's time, I think, to bring on our number 1 A-list guest today. I see that he's on. And
I get the honors.
Oh, yes, you look. Everyone, gaze upon that handsome man that you see right there sitting in front of you. All right, so Victoria, why don't you welcome our special guest?
I'd love to. Okay. Adam, we love working with you. He is a chartered financial analyst, a certified private wealth manager. He's a senior portfolio manager with City National Rochdale. We have had a relationship for many, many years. Adam joined Rochdale in 2006, and I was so happy to see that. I've monitored the company, and I spend a lot of time on due diligence when we choose to start working with a strategist, because that is a recommendation that we make to our clients. And I've had to fire some in the past, Damon. I've had to fire UBS Global. I had to fire Goldman Sachs because they weren't performing for our clients. And that's all I care about. And so, Adam, I love you, buddy, but
but you got to keep doing your job.
That's right.
What have you done for me lately? I get it.
Yeah. What have you done for me lately? But we have had a very dedicated relationship and a wonderful relationship. Our clients could not be happier working with Rochdale. And he's one of our strategists. You remember when we came on and I said, we have what we call an open architectural platform. That means we can go out in the universe and select, and we have a company, AssetMark, that does due diligence on these firms for us and for you, but so that we can go in and say, yes, these are the kind of strategists that we want. They have to be long-term. They have to be work with a team. And we have certain criteria here at ChappelWood that we really work with. Now, with working with Rochdale, their minimums are our minimums, $1 million. They work with millionaires. So millionaires have different needs than other folks. So we want to make sure that we match up the right strategist with our clients. We had a gentleman in recently, he's a lovely man. He couldn't be here. He wanted to meet you, Adam. His name is Ellis. Come to find out, lovely, I did match him up with, he was just kind of in the market maybe. And then I said, listen, I know who your personalities, what you need, he's qualified for. But more importantly, it's got to be a good personality match. Ellis couldn't be more happy. He was in thanking me in the office. But he's clay shooting, as it called. He's going to Tucson with his brother. There's this big, I would never have suspected this gentleman, but he is a clay shooter. And I cannot wait. I said, well, we have that in Oklahoma. I'm going to go out with him. As soon as my shoulder is good enough to go out there and shoot. I've never done it. I've never done it. I'm going to do it.
All right.
Just, I'm putting it out there right now. Can't wait. So anyway, I want everyone to help me because, you know, as I said, Adam is the senior portfolio strategist. Rochdale as the company is one of our premier, is what I would call, just like we're known for premier service, they are known for premier service. And one of the only companies that we really work with that we can get on the phone, our clients, not just us, our clients can get on the phone with our senior strategists, you know, when things happen in their lives. And what I really attracted me to Rochdale is all the things I've already listed and their proposals. When I always want to sample one so our clients can see. Now, they can be very, very short. We call it abbreviated, or, you know, an 84-page. What they do and what they have helped us with our clients, and what I appreciate the most, is that when people, as Damon had said, they're starting to think about retirement, and we've had it on autopilot. Now I need to maybe make some adjustments. Well, we look at how we can reduce the risk and actually increase maybe our dividends, our yield. And so they have a report that shows us how we can do that. I mean, real data that says, hey, this is where you are, and this is where, you know, 3 choices of where you want to be on your risk tolerance. So I really do appreciate that, Adam, so much. I know you know I do, and I appreciate your interactions with our clients because you speak English, and that's very important to me. So let's all welcome him.
Yes.
Thank you for being here from New York. How is it up there?
That was the best introduction I've ever had. Thank you so much.
You're welcome. I'm for hire. I'm for hire, Adam, just so you know.
You are hired. I'll take it. New York is okay. We're progressing slowly, probably slower than most of the rest of the country. But
yes,
we heard some good news today, actually, which is after 2 years, we are headed back to the office at the end of March.
Yay!
So it's been crazy. I have literally been in this closet, not every day, I go out when I'm not working, but for 2 years, I have not been back in the office. So everything, I run a team of 6, right, virtually every single day. And it'll be nice to have some form of normalcy.
Absolutely.
Excellent. So that's some good news. So give us some more good news. Tell us why we should be excited about the market, and go.
Sure. So just so you know, if I were to have participated in that poll, I would have been one of the 60-ish% that would believe the markets will be higher at year end. Just so you know, and it's important to understand what the market's doing, why it's doing it, why we're still confident in the outlook for both the U.S. economy and the equity markets going forward. So I'll try to not be too technical here and just kind of give you sort of an overview. It may start a little technical, but then hopefully you'll understand as we go forward. So what is the stock market doing? Well, when you think of what a stock is worth, right, it's really nothing more than the future earnings of a company, right, that are discounted back to today's level, right, using today's dollars. Well, how do you determine what that is? Well, you make an assumption or a forecast of what you think that company will grow at year over year, and then you discount that back to today's dollars. Well, the discount rate that is used to determine the present value is an interest rate. And as interest rates are expected to rise, right? The present value of stocks decline, okay? So what's happening in the stock market is absolutely healthy, it's absolutely normal, and I guarantee you it's what happens every single time the Fed begins, or at least announces that they will begin to raise interest rates. Nothing different about this time than any other time previously. The markets are resetting into a new present value based upon a discount rate that is higher. Now, what we've seen recently since the beginning of the year is some, I would say, some pretty extreme volatility. Not that the market shouldn't be down, but the speed and at which it declined was a little odd. But then you have to remember that the Fed has changed paths very quickly, and the narrative has been adjusted multiple times right over the course of the last 6 weeks. Just in November, the Fed wasn't even thinking about raising rates. Right, all they were thinking about doing was reducing the amount of bonds that they've been purchasing since the pandemic started. It was not intended to tighten policy. Policy would still remain accommodative. It's just not necessary to buy as many bonds. And that has now evolved to potentially raising rates upwards of 7 times between now and year end. And just so you know how this works, the Fed meets every 45 days. Okay, there are 9 meetings a year. There are 7 left. All 7 are what they call live meetings, meaning that the Fed has the ability to raise rates in any or all of those 7 meetings. So that is exactly what they are preparing the markets for. The Fed is unbelievably methodical. So sometimes you want to scratch your head and say, well, why did they come out and say this? Why did they say that they want to raise rates 7 times or 3 times or 5 times? Well, they're preparing the markets. They want the markets to price it in. So the fact they don't even necessarily have to do anything and the market tightens itself. And therefore, they don't always have to move forward. If they need to, they will, and they do it without shocking the market. That's the key to all of this. So markets are doing exactly what they should be doing right now. Okay, so I want to be very, very clear about that. Does not mean that we're in a market meltdown, does not mean that we finish in negative territory. But until there's a catalyst to drive the stock markets higher, they still have to continue to reprice this higher interest rate environment. And the problem with what the market is dealing with right now is there's a lot of uncertainty. We're not going to talk about the Russia-Ukraine situation. We can talk about it later, but just for this context, they're just simply trying to determine how many rate hikes will actually occur this year. What is the appropriate discount rate to use? And to be perfectly honest, the Fed doesn't know the answer either. All they know is that they're behind the curve right now because inflation has remained higher than what they expected. They will begin the process of raising rates in March, but things can change, right? What can change? Well, COVID can change. I would say that's the number one, right, concern right now, which is, are they tightening too quickly if COVID becomes an endemic, right? Because if COVID actually does become an endemic, then what actually happens? Well, you would have to assume we learn to live with this virus going forward. Spending patterns start to normalize again. So we don't spend all of our money on goods, right? We start to spend again on experiences and services and activities. Well, most of the inflation that we're seeing right now is on the good side. So if patterns normalize in terms of spending and we spend more on non-good related things, right? Well, what happens to goods inflation? It will come down automatically. The other big thing, which is why the Fed is moving so quickly now, is wage pressure or wage inflation. And I think the Fed was a bit surprised how tight the labor market actually was. They're really not concerned about goods inflation, to be perfectly honest. And we can discuss later how it happened, but the Fed was concerned about the second mandate, which is max employment. And they were shocked how quickly we got there. We got there in December when the unemployment rate dipped below 4. And why the Fed was so shocked was because we're still 3 million payrolls lower than where we were pre-pandemic, and there's 11 million jobs available unfilled. So there has to be slack in the labor market, right? There has to be. You want a job, you find a job. Unfortunately, there's a lot of people that don't want a job. And so the labor force participation rate is lower than we were pre-pandemic. And there's lots of different reasons for it. You can definitely say that there's some people that just don't want to work. I think that's a fair statement. There are COVID and non-COVID related issues that are keeping people out of the labor force. Non-COVID related, opioid crisis, right? We don't talk enough about it in terms of people becoming unemployable. That is a problem. for working age population. You also have COVID related issues. You have an aging population in the US that's taken early retirement. You have daycare and homeschooling issues that have caused parents, especially women, to drop out of the workforce. You have COVID related risks. You have vaccination mandates, right? All of these things are keeping people out of the labor force. Participation rate is light. Now we have a tight labor market, which requires higher wages. Higher wages is a problem, not for the consumer, we love it, but for corporations, because they end up raising their costs or raising their prices because they have to offset those higher wages. That creates higher inflation that lasts longer. Wage pressure is sticky, right? You never hear about people getting wages cut unless we're in a recession. So that becomes a little bit more of a problem. And once they found out we actually are in a tight labor market and both their mandates have been met, they're going to move, and they're going to move reasonably quickly. And so again, markets have to price this in, but just like the goods inflation, right? This could easily come down as well, the wage pressure, if COVID becomes an endemic and more people re-enter the labor force. So there's lots of things that are out of the Fed's control that unfortunately they have to deal with. And they don't know if and when, things will change. So they're going to start to move, and they can always stop or pivot like they've done before. And we'll wait and see.
So Adam, you mentioned just a moment ago that if you had answered that poll question, where do you see the market ending by the end of the year, you would have been in that 61% that said somewhere between 0 to 10%. Why do you feel that way?
So it's a good question.
That's why I asked it. I asked the hard-hitting questions.
I would never say that's not a good question, David, to say no, but yeah. So we look at fact patterns to determine where we think stocks will finish for the year. And the typical fact pattern that we look at is economic activity, corporate profit growth, and if the two of them are aligned, that usually translates to a strong stock market. If you look at economic activity and output, right, the U.S. economy is expected to grow somewhere between 3.5% and 4.5% this year. That's on the back of a very strong consumer absorbing higher prices but still spending, and businesses believing that the demand, right, will continue from that consumer, and they are continuing to rebuild inventory. They are expanding capacity, whether that's through hiring if they can find workers, or through investment in technology and automation so they don't need as many workers. When you break down those two components, business investment and consumer spending, it's over 80% of the U.S. economy. So it's hard not to like the prospects of the U.S. economy, even though we're dealing with inflation. I know inflation tends to get a bad rap a lot of times, but it's really only a problem when people can't afford things and consumer spending declines. But we're not seeing that yet, right? We complain about spending more, we hate spending more, but we're still doing it. So we expect the U.S. economy to grow at an above average pace, and corporate profits are expected to be above average true. We're saying a range of 7 to 17%. I would say the median figure there, 10 to 12%, seems like a reasonable number. And the key there is just the relationship between corporate profit growth and market returns. They're very highly correlated. And so, when you think of it from that perspective, equities can do quite well, but I do think it will be a little bit more concentrated returns this year. Last year, everything did well for the most part. Profits were through the roof, right? Again, every company raised their prices. We're able to pass through the additional costs. We were comparing earnings growth from 21 to 2020, which was in contraction. So all the comparisons were very favorable. 2022 becomes more challenging, and with a limited budget, right, that consumers have, they're going to start to be a little bit more choosy if inflation remains high. And so what are they going to spend on? Well, they're going to spend on things that they depend on, right? That they need every day, that they can't live without, that there are no substitutes for. Energy, industrials, materials, financials, software, right? All things that we need on our, in our daily lives. Those things have pricing power, right? Those companies should be able to raise their prices and pass through the excess to the consumer. That means stronger earnings, stronger margins. There's going to be others that can't, right? That have raised their prices probably as much as they possibly can without seeing a reduced demand. And so what that means is they'll be absorbing those higher costs internally, right? Input costs, wage pressures are going to eat into earnings. So we have to be a little bit more selective in terms of what we buy this year. But I would say, broadly speaking, equity markets should move in line with corporate profits, which, again, should be pretty nice this year.
We do have quite a few other questions here. So Ali, why don't we go ahead and launch in? Hit us with the first question. We had several that were submitted beforehand, so let's start with those. What do we got?
Absolutely. So the first question here comes from Ralph and Marty. Does Rockdale use ESG scores in evaluating companies for investment? Adam?
So that's a little bit complicated. The answer is yes, we can. We don't do it for all clients unless they request it.
And Adam, real quick, can you explain what ESG
Yes.
stands for?
Thank you.
Yeah, so there are all different types of screens, right, that we can include in a portfolio, right? Some are based upon social beliefs, some are based upon, in this case, environmental, social, governance, right, types of screens. So there are negative screens out there, there are positive screens out there. So let me explain the difference. A negative screen would say, we're going to exclude a company or an industry or a sector based upon certain practices. Those could be practices that the client does not believe in, or doesn't meet their or go along with their beliefs, or if there's if they are ranked low in that ESG potential score. That's the negative screen. So yes, we can absolutely do that. There's also a positive screen. A positive screen would be to classify each stock or rank each stock based upon this ESG score, not that we provide, but there are all these different sites out there that score these things in different ways. Depending on the site, there's going to be different scores. But if they, depending on, again, their diversity, whether they give back to the community, all different types of things that, fall into that category. So why it's a little bit complicated is because every client is different. Every client thinks of things differently, right? Some people, may just look at things in terms of from an environmental perspective. They don't care that the board member or that the board consists of 2 women, 3 minorities, et cetera, et cetera. These scores take all of this stuff into consideration and is, in my opinion, not completely appropriate for everybody because it's just a broad score. We would prefer to drill more into what is it that you want us to screen for, right? And then we can do so rather than just giving you a broad-based, screen. There are plenty of mutual funds and ETFs that already do that. But again, you're limited to what they want to own or what they believe is true ESG investing. And what you'll find out is there, a lot of things that actually get a high score in terms of ESG really should not be even classified as ESG. So it's not a perfect science at this point in time, but it can be done. We can do it, but we do not do it unless asked.
And there's a part 2 to this question too. It says, should we be concerned about the growing influence the influence of ESG scores on the future of the companies that we invest in?
I think you just did a really good job of explaining the good and the bad. So the second part of that, Ali, don't you think, or is there more you want to add to that? Because I want to share a couple examples from our clients.
The only thing I would just add to that is, what you're going to find is, big mutual fund companies, big ETF companies are the major shareholders of most corporations at this point in time. So they're going to have a lot of voting rights and control over the board and what investments some of these companies actually make. So the reality is, if you're concerned, right, about those companies like a BlackRock as an example, or a Vanguard as an example, making decisions for you, based upon them being a shareholder, then you probably don't want to invest in, Vanguard ETFs or funds, or BlackRock ETFs or funds. You'd probably want to be more selective in terms of what you actually own.
Well, we've had some really good success, and our clients are thrilled when they know that we can go in and say, we have, if you probably don't recall this, you have so many clients that you work with, but we had a client that called and said, I want nothing to do with firearms, nothing to do with that. And we had a call with her, and she got, after a shooting, and she got it was an emotional call. However, when you got on the phone with her and you said, well, what about military? And she went, well, no, not military. No, I have to, our veterans, she is a huge veteran and military supporter. So, just having that conversation and bringing it up and said, and we made some adjustments. We had clients that came in and said, we're really against anything with tobacco, with alcohol, any of those. And we were working with it. And the question came up, well, Adam, if we take a stand on that, how much is that going to affect our return? And we were very pleased to say, because it is the client's choice. We get to choose. It's just like if a female says, I don't want to invest in any companies that don't have women on their boards. I mean, you can get that deep into this, but most people really, social investing is important to them, and you can make some adjustments. And it was wonderful that with our clients that we've done that with, and there's been so many, those are the two that I think of off the top of my head, that they're still so pleased with their performance and the balance of their portfolios. But knowing we can make those adjustments, that's what people want to know. I have the control.
That's right. Absolutely. Absolutely. Yeah. When you start working with a strategist like Rochdale, that, think about it, you're building a house. Rochdale is a fully customized house. You get to pick every bell and whistle down to the number of specs that you want in your marble tile or something like that, So anyway.
Damon's building a house, just so y'all know. So there's going to be a lot of houses.
Everything revolves around a house, right?
Everything you do. And he's just getting started. He's just doing the land work, the field, the bridge. He's going to get there. He's going to just get to the point and go, I don't care where the plugs go. I don't care. On the other hand, I want to know where every plug in my house is. I want to know every plug in this building is.
That's right.
So,
all right.
Next question, Allie.
Yeah.
Yes. Okay. From Lori, Sandra, and Ralph. It's about inflation. The Rochdale speedometers indicate inflation is in the green positive area. What is this measurement based on, given the current high inflationary environment?
Aren't you glad, Adam, we're using those?
Yes, they're great. Thank you for sharing.
For context, everybody, what Rochdale does is they've got about, I think, 20 economic indicators, right, Adam? And each one of these is measured using red, yellow, or green. And everybody understands red is bad, yellow is caution, green is good, right? And it measures all of these. Right now, most of these 20 speedometers are in the green. A few of them are in the yellow. And so, yeah, inflation is one of those in the green. How can inflation be in the green, Adam? How can it be good when we're seeing prices what we're seeing?
God, you guys are hitting on some hot topics here. I've had so many debates about this color of this particular indicator now over the last few meetings. So inflation's bad, right? We all believe inflation is bad. And sort of what I was alluding to before is, we think of it bad because we hate spending, more money on the same goods that we've been buying for much cheaper. The reality is, as I mentioned, inflation is bad when we no longer can afford things. It impacts demand and spending, and we slip into recession. But the reality is, the U.S. consumer on average has the means to afford higher costs. Okay, we have a net worth that's at an all-time high. We have, or there is a wealth effect that has been created. It's actually been created by the Fed. Home values are higher, stock values are higher. People feel more wealthy and they tend to spend more. Under that scenario, borrowing costs are still cheap, savings rates are high, wages are rising. Okay, so all of that is real, and it means that consumers, for a period of time, not forever, but for a period of time, can afford higher costs and they are still spending. So when we think of the indicators, right, all they're doing is giving some perspective about whether we believe it's having a positive, negative, or neutral impact on the economy. Inflation is not having a negative impact on the economy. It feels like it's having a negative impact, but it's not. And remember that beyond just consumer spending, businesses are making more money than they ever have. Right? Earnings grew close to 50% last year, right, for large corporations, because they all raised their price and passed it through to the consumer, and the consumer absorbed it, right? So what does that mean? Well, they make more money, and then that translates to higher stock prices. It translates to more hiring, more investment. So it hasn't had a negative contribution. I understand what people are saying. How can it be positive? But in the sense that the way that we look at it, it has so far been a positive contributor to the economy and profits. Again, may not last forever, but it is the case right now.
Good answer.
That's right.
All right, next question comes from Dan. What process does your team go through when evaluating dividend stocks for generating retirement income?
So we have a specific strategy that does focus on companies that have a track record of paying dividends and growing those dividends. So we have specific criteria that have to be met. That criteria, and again, this is not client specific. This is a strategy specific criteria. There has to be a 10-year track record of dividend growth. The dividend has to be growing, or had to have been growing, at somewhere between 4% and 6% every year. Historically, it was they had to be more recession resistant types of businesses. It was more of just a risk off type of play. We've evolved that a little bit because there are plenty of really cyclical companies out there that are flush with cash, that are paying dividends, that are not a recession hedge, but are absolutely an inflation hedge. And so that's part of the screen. And I would say it does have a slightly lower beta or lower risk profile than traditional equities. But it's really about track record of dividend growth and continuation of that dividend growth moving forward. The last thing we want to do is own a company that could potentially run into cash flow problems, be forced to cut their dividend. And we know what happens when that occurs. The overall share price takes a bath because everybody who's owning it for that dividend, right, jump ship.
And let's jump over to a question that we have in our Zoom chat. So this question comes from Jan and Chuck. They're actually on live with us right now. The question is, what continues to drive the hot real estate market, and what is the outlook for that over the next year?
Bunch of different things. Cost of capital or cost of borrowing is still very favorable, right? Even with rates beginning to rise, the 30-year is still hovering right around 4%, right? Meaning which is the 30-year mortgage, fixed rate mortgage. So cost of borrowing is still very cheap. There has been a massive demand for homes simply because of COVID related issues. People were relocating and people didn't need to work as close to or live as close to the cities where they tend to work, metropolitan areas. So the suburbs, we're seeing excess demand. There's not enough supply. People aren't selling. There's just real estate is underbuilt, right? From a residential side, it's been underbuilt for the last decade, ever since the global financial crisis, because so many home builders went bankrupt during that period of time. There's an immigration problem. Land is expensive. There's no workers. So it's hard to find materials. So there's a lot of different things. And at the same time, the millennials who we thought were not interested in owning homes and starting families, they wanted the flexibility to rent, changed path, right? They got older. They're dealing with COVID issues. They're not living in metropolitan cities as much. They're buying homes. They're starting families. And now there's competition, right? There's competition for the few and far homes that are available to sell. So there's still heavy demand, and the cost is so, not the price of homes, but the cost of borrowing is so cheap that there are bidding wars, and that's driven, prices significantly higher. I don't see that changing much. I don't all of a sudden see that there's going to be a significant amount of new homes that are created in a short period of time that meets the demand that we have. And again, it's a domino effect. If a lot of times where there's turnover in the suburbs is you have older people, right, whose children work their way through the education system and they pay taxes for schooling, and then their kids grow up and they are out and they go to college, or they're on their own and they decide they want to downsize. But unfortunately, there's nothing to downsize to because there's a shortage of supplies. So they're not moving as quickly, and so there's then you have the second time home buyers who are moving out of their first time home to something larger. there's no flexibility or supply there, and now you have the first-time home buyers that can't buy the first-time homes because the second-time home buyers still own those homes. So there's a lot of issues there. But the reality is, one of the things that the Fed is intending to do is raising borrowing costs, right? So we will see that have an impact. I don't think it's going to be too material. Remember that the impact that higher borrowing costs have is usually delayed. There's a lag effect. So you're not going to get to a point where the 30-year fixed jumps so high that it's going to make things unaffordable immediately. That may happen in the future, in the next couple of years, but not going to happen right now. So cost of capital is still cheap and there's demand, right? It should keep home prices high for a period of time.
I feel this on a personal level because my husband and I are in the process of buying a home, and woo, it's a madhouse out there. Next question comes from Mary Sue. What do you see as the biggest threat to the market in the next 6 to 12 months?
So I may surprise you with this answer because the answer should be the Fed, but I'm not going to say it's the Fed. I don't think the Fed is going to ruin the economy or the market in the near term. If I had to guess, I would actually say it could be geopolitical tensions. And normally markets overlook a lot of that stuff because it doesn't have a real impact on corporate profits. This is a little bit different of a scenario, right? And it gets back to the cost of energy, the cost of foods, and what households have to spend on both. So, remember that, we have a shortage, right, of production right now coming from the energy industry. And we know all the different reasons, whether it's a, push for global decarbonization, that's certainly one of it. There hasn't been enough investment in infrastructure or overall drilling and fossil fuels. You also have to remember that back in March and April of 2020, oil prices turned negative for a period of time, bankrupting a lot of exploration companies and drilling companies. And so even as prices have gone up and they've tried to kind of reestablish themselves, they've had a hard time loading up on labor again for all the same reasons that every company is having a problem. If machinery is out of date, they're having a hard time finding new supplies because of supply chain problems. And it's not just happening in the US, it's happening globally, right? OPEC Plus is still producing way below pre-pandemic levels. They're dealing with the same issues that the US is right now. So you have this shortage of oil or an overall energy, and you have one of the bigger suppliers, which is Russia, right, on the verge of an invasion of the Ukraine. So again, not guaranteed that this will happen, but something that keeps me up at night. If Russia does choose to invade the Ukraine, right, then you have to assume that the West is going to put on some pretty severe restrictions, right? It's going to happen most likely. And so, to spite the West, it would not be unthinkable, right, for Putin to cut supply, right? Even if it hurts the Russian economy for a period of time, they don't care. They know that it will hurt the European economy most specifically because Europe consumes so much of Russia's exports, right, with regards to energy, right? 40% of all nat gas consumption comes from Russia. So that is possible that all of this happens. Sanctions lead to a supply cut by Russia, which would then, create a larger supply demand problem for a period of time, which could cause prices to skyrocket, right? That's the oil shock or the energy shock that we haven't seen in a long time, but is problematic because it creates a problem with household spending. You add on top of that, right, the fact that between Russia and the Ukraine, they produce about 30% of all wheat globally, right? You have to be concerned also that if that comes down, right, we're going to see food shortages. So from a consumption perspective, right, if we're already dealing with inflation of goods, right, and now we're dealing with higher energy costs, higher gasoline costs, higher natural gas costs, right, heating our home, filling up our tanks, and we're continuing to pay higher prices for food, what's left in the household budget, right? And then you start to be concerned about the real impact of inflation. and how that will impact consumer discretionary spending. There's not going to be enough left in the discretionary budget to keep the US economy in expansion. So once the US economy shifts from expansion to slowdown or potential recession, that is typically when you see the big market declines. So long-winded answer, I don't think the Fed ruins the economy or the markets. I think it's a real possibility if energy prices spike to the $125, $130 level and stay there on West Texas for a period of time, the US economy could be in trouble, and so could the markets.
Let's go over to a question from our Q&A. So this question comes from Lynn, who joins us live. She says that she knows that Damon has talked about buying Bitcoin directly, but now she's asking, your thoughts on buying Bitcoin stocks or having them in our portfolio.
Crypto conversation. Everyone has different viewpoints on this. So I think you have to determine why you want to own it, right? Which coin or currency you want to own and why. And so historically, one of the values that cryptocurrencies bring to an investment portfolio is the lack of correlation to stock and bonds. And so when you add it to a portfolio, right, a non-correlated asset tends to create a higher risk-adjusted return. So there is precedent for wanting to own it, in an investment portfolio. But the problem is, if you look recently, you've seen that correlation completely change. It's almost 1-to-1 with like tech stocks right now. So it's a risk asset, right? And it's moving like a risk asset. So when there's a risk on market, it's moving up, and when there's a risk off market, it's falling. That loses some of the allure, in my opinion, of why you'd want to own it from an investment perspective for the non-correlated component. There's obviously plenty of other reasons to own it. And again, whether it's you're looking for a decentralized way of moving money, but keep in mind that each currency is really not a currency, it's a software, right? And this is really a separate conversation for a separate time. But there's reason that there's so many coins because there's so many needed software, and they do different things, right? Each one does something very, very different. Some, like Bitcoin, just use the blockchain and move money from one place to the other in a decentralized way where everything can be validated. There's others that move property rights, like a non-fungible token, like an Ethereum. So it's not a homogeneous, I can't even call it an asset class. It's not a homogeneous currency, if you want to use it that, because there's so many different ones and they do so many different things. I would not classify it as an inflation hedge at this point in time. It's because again, there's nothing to suggest, with the exception of Bitcoin, that there's a finite amount of these current coins available. Most other are infinite, so that reduces some of that inflationary hedge. Like the fiat currency, that's the problem with the fiat is you can just keep printing dollars. It's definitely becoming more mainstream. I think the blockchain itself is absolutely becoming more mainstream, and you're going to see it change a lot of things. You're already seeing it from decentralized finance, financial technology. All these things are going to replace traditional ways of doing things and moving money. But the way that I would look at this, at least for the time being, is if you put money into it, don't expect to take money out of it, right? So it could easily go to zero as easily as it could double or triple. So that to me is nothing more than play money that you put aside, and you hope it becomes very mainstream in the 1 or 2 currencies that you own, take off and make you a whole lot of money, or just like gambling, because that's what it is, right? It's a pure gamble and speculative investment right now. It could easily go to zero and you could lose all your money. So from our investment perspective, we can't own that right now for you in a portfolio. And again, some of the benefits that we've seen in the past for why you might want to own it have sort of faded as well. Doesn't mean you can't make money on it, just too much risk in it for us right now.
And real quick, ladies and gentlemen, I'll put in a quick plug for our Wednesday lunchtime drive-through. It's our weekly webinar that we do. And if you go to our YouTube channel, Financial Diva, it's all one word together. We have a playlist for all of our past Wednesday lunchtime drive-throughs. There are 2 episodes. Each one is only about 30 minutes. One of those episodes is the pros and cons of investing in Bitcoin. You might be interested in that one. The other one is, what are NFTs, non-fungible tokens? And so if you want to find out a little bit more about those, I kind of guide you through in 30 minutes about those. So go check those out.
Next question comes from William, who is on right now with us. He says that gold, silver, etc., are supposed to be a hedge on inflation, but spot prices have been very volatile and prices are flat or lower year over year. Why is that?
Again, getting back to that inflation hedge, the precious metal inflationary hedge relationship has broken down recently. I would say 2021 is just the prime example of that, right? In a year where we saw excess inflation for the first time in over a decade, gold prices were down. So why is that? There's not a great answer for that. But what I would just say is that gold is not thought of the way it used to be thought of, right? I think when, people who grew up in, the 60s and 70s, when we were still, tied to, or when the US currency was still tied to the gold standard, they viewed, it as a precious, metal, a commodity that, was a safe haven, it was a store of value, and it was, just a conservative way of having a portion of their assets invested. I think that's totally changed. I don't see this newer generation even caring about gold whatsoever. They don't think of it like that. They were never tied to the gold standard. They don't view it as that store of value. They actually would view Bitcoin or crypto like that. Although, again, we've seen it, be volatile. But gold and silver can be, and all precious metals can be just as volatile as equities. A lot of it is based upon futures contracts and where the demand is actually coming from. So it is not the traditional inflation hedge that most people think. And so again, it's one of those speculative investments. What are you owning it for? It doesn't pay you, right, any type of dividend or cash flow. And so you're owning it either A, because you think of it as a safe haven, right, or you're expecting it to appreciate in value for some reason. But I wouldn't say that the reason should be inflation.
All right, a question from Rick. With the interest rates probable to increase this year, what moves, if any, should we be making in our bond portfolio? Yeah, so probably the least productive asset class out there right now, outside of cash, and maybe even gold for that matter, would be bonds right now, or at least traditional bonds, right? It's pretty simple. I mean, if you think about it, right? Inflation's higher, right? Coupons are fixed for the most part, right? So you earn a fixed interest rate and you take that money and you go spend it and pay higher prices for everything, right? That is not productive. And so traditional fixed income has been somewhat of a dead asset class now for the last couple of years. Returns have been negative, yields are deeply negative, right, on an inflation adjusted basis, right? Meaning that, just give you an example, if the 10 years trading at a 2% yield and inflation's at 7%, right? Well, what happens to that 2%, right? You lose 5% of your value on that portion of your assets year over year. So at the same time, the value of those bonds decline when rates rise, right? There are new bonds that are being issued at a higher rate. Why would you want to hold one with a lower rate? That's why bond prices decline when rates rise. So I would say, again, I don't want to deter people from owning traditional fixed income. I think it's still a safe haven, and again, it's a safety net. They don't drop as far as stocks, in a down market, and tends to be on a risk-off investment. But it's not going to keep up with inflation. It's going to perform poorly in a rising rate environment. So option B on the bond side would be floating rate, certainly, floating coupons, right, that rise every time interest rates rise. That's an absolute win there, and we have a lot of that in our portfolio. Short duration, high yield debt, right, taking on credit risk rather than interest rate risk. So
not to get too crazy in terms of the bond story, but there you get compensated for different types of risks when you own bonds, right? There's a term premium, right? Meaning that the longer you lend to a company or a government or a municipality, the more yield that you would require, because there's a longer time of that loan and a higher probability of potential default. So there's a term premium there. There's a risk premium by lending to companies, right, with investment grade credit rating compared to treasuries, and then non-investment grade credit rating compared to investment grade credit rating. And so the question is, what do you want to own in this environment? Well, I would look at corporate balance sheets right now. If you're going to own, corporate debt right now, I mean, balance sheets are unbelievably strong. And I'll give you a quick anecdotal story. I was meeting with a client yesterday, or speaking with a client yesterday. He's a major bankruptcy attorney for corporations in New York. And we had a call yesterday at 9 a.m. I said to him, I'm shocked that you can do a call at 9 a.m. Usually we're at like 7:30 in the morning or like 6 p.m. at night. He's like, we're not busy, right? We have no business, and I don't expect to have any business all year long. And that's a reflection of the government and all the transfer payments that were made during the pre-pandemic to corporations. And so the corporations are flush with cash, right? And they're seeing good free cash flow. They have good revenue growth right now, and they're able to meet their debt obligations that they have. So I think it's totally fine to lend to those types of companies, both public and private, right, for a finite amount of time, a couple of years, and you're going to earn a higher rate, right, of interest on those loans. So right now we're looking at the 6 and 7% yields on those types of investments. And again, you don't want to own those in a recession, but as the economy is expanding and and corporations are flush with cash, 6 to 7, right, helps you offset the impact of rising rates, helps you offset inflation. So if you're going to own bonds, it's either floating rate or some type of high yield debt that you're comfortable with the credit ratings of these companies.
Okay, this is the last question that I have. So if you're on with us live right now, go ahead and submit your questions either to the chat or by hitting that Q&A button. But this question comes from several of our clients, and I know that we've talked about cryptocurrency a little bit during this Q&A session, but this is something that I think you guys can kind of add on to. At what point, if any, will Rochdale join the crypto revolution? Do you have an answer for us there, Adam?
I don't have a great answer for you there. Again, I don't think we're ever going to be the wealth management firm that is comfortable with your assets going to zero, because there is that possibility. I think when as it becomes more mainstream and as there's a larger ownership of crypto, right? If you look at the kind of the ownership of the major coins, right, it's very, very concentrated. I mean, there's a few investors that own a large amount of those coins. And if they chose to jump ship for whatever reason, right, you would some of these coins would actually go to zero. It's quite possible. So you would need to try to figure out some type of intrinsic value, right? Everything we own has to have a value, right? So how do you value that? Well, you can't discount cash flow because it doesn't pay anything. It's not a real store of value, right? So you can't add it as a currency. So we have to figure out how to really define it and where it really belongs. I'm not saying that it will never happen. I think it is possible, but you have to get the speculative money out of that market right now, right? Right now, most people buy it because they think it's going to go up in value. I mean, that's totally the truth, right? They think that someone is going to come behind them and pay more, and they're going to make money off it. They're not owning it because they want to transact in decentralized currency. So I think once you remove the speculators, then you're not going to see these major 20 and 30 and 40% moves in such a short period of time. Then you can figure out a way potentially to invest in that that is safer. Right now, I think we're still a far way away from that.
I believe that's everything that we have. Victoria or Damon, do you have anything to add or questions for Adam that you might have come up with?
Well, we are coming down to the end of our time here. So Adam,
Yeah.
I think
Is there anything else that you'd like to add?
Yeah, do you have any final parting shots here before we close this party down?
I'll leave you with this, which is, as I mentioned, there has to be a catalyst for stocks to go higher. Okay, so right now the markets are reacting, right, to the Fed most specifically, and unfortunately, there's that catalyst of corporate profit growth is really not going to be present for a while. Remember that everything is delayed, right? So in the first quarter of 22, we're still getting fourth quarter of 21's, right, earnings numbers. In the second quarter of 2022, we'll get first quarters, but first quarters will look very weird because of Omicron. And so we're really not going to get true, I think, data that reflects the current environment until the third quarter, of where we're starting to see second quarter numbers reported. So it does not mean that markets won't recover before then, but fundamentally speaking, it may take us, right, to the third quarter to see a recovery. It doesn't mean that the markets continue to melt down, but we may not see a big increase in the near future outside of, again, some short squeezes that just drive the market quickly higher. So, just be patient, right? It's, again, if this turns into be something more than what it is, right, then we will take action. But as of right now, this is not the markets are not reflecting a weaker economy. It's actually just the opposite. And you're seeing it in the way that the relationship between bonds and stocks, right? They're moving in the same direction right now, right? Stocks are falling, bonds are falling. Why? Because interest rates are rising. You would typically see the opposite happen if the economy was coming to a period of time where we were going to see weakness. Bonds would be rallying over that risk-off demand for bonds, and stocks would be falling. So it's just a period of time, right? As you guys were mentioning, or early in the call, right? This happens, and when you're coming off of a few really good years, not totally surprising that we're seeing a little bit of weakness. But at the same time, right? I think that when it's all said and done, I'm part of that 60% vote there that would believe that the markets will be higher by year end.
You know what, Ali, we do have one final question in the chat. And Victoria and I were just saying, no one's asked about this, but Bill, we know you're out there, and
Bill,
you
my
asked probably the one question we were shocked that no one's asked. So
yes.
Ali, go ahead and share with Adam what this question is.
Is that on the chat right there, or?
It's in the chat. Yeah, it's in the chat.
Oh, okay, the last question there. Okay, do you see any changes in the market if control in government flips in November? Oh, good question.
If it flips, probably not, although I would give it a tilt towards the upside rather than the downside, only because heading into let's call it the third and fourth quarter of last year, when you had all these new infrastructure bills on the table and this Build Back Better plan on the table, right? There was certainly concerns over inflation and all this new money supply and higher taxes, right, for both households and corporations. I think that's a negative for the market up front. That spending doesn't occur till later on, and yet taxes happen immediately. So higher corporate tax rates would eat into earnings, which again would eat into the market. So I think if the House and the Senate both flip, the likelihood of one of those types of proposals passing that includes higher taxes is probably lower. So I would say that I don't know the market cares one bit, but if it would, I would think it would tick upwards rather than downwards because of, again, their policies won't be as tight.
All right. Well, Adam, thank you very much. We are now just a few minutes here towards the end of our time. And so we want to thank you very much for being our special guest. We always love getting the chance to visit with you.
It's very insightful.
Yeah.
And I really appreciate you speaking English so that everyone could really be engaged. And like I said, it's very insightful and very much appreciated. You carving out some of your really busy time to be here with us. So again, Adam, thank you very much.
Yes.
My pleasure. Thank you all for having me. I really appreciate the partnership.
You can't hear it, but everyone is applauding for
Everyone
you.
is applauding.
So
there's a little icon down there now, so
that's
that
right.
people can actually raise their hand and clap.
So ladies and gentlemen, this is not the end of the learning. Okay, there is more learning that can be done. And so we want to, number one, let you know that if you're ready to take some action, you need some assistance, you can call or text the word gold to our phone number 405-348-0909. If you're not already a member of the ChappelWood family, you want to take advantage of our Gold Bucket Optimizer to get some of this great guidance that
That
you've
is
seen
your
today.
reward for being here
That
today
is true. That's right.
and participating.
You can also register for our Wednesday lunchtime drive-through. That's our weekly webinar. You can enroll in one of our classes, Rocket Retirement. I teach it at Francis Tuttle Technology Center in the Oklahoma City area. You can listen to our podcast, our radio show. It's all about the money, honey, on iHeartRadio. If you want to listen live, that airs at Saturday at 1 p.m. Central, Sundays at 6 a.m. Central. That is on the iHeartRadio app on your mobile device or your computer. And then you can always subscribe to our weekly e-newsletter. We always send out all kinds of information about what's going on in the market and how you can benefit from the kinds of information like you saw today. Adam is just one of the many experts, one of the many professionals that are, we call it boots on the ground.
Mm-hmm.
What you don't see behind Adam is the team of professionals that is managing all of these different aspects of portfolios. Adam is like the tip of the spear, and he's the one that brings that information. So it's a great resource. I do have one final poll question that I want to ask you. All right. If you enjoyed what you saw today, whoop, there we go. No, there we go.
Jelly.
If you enjoyed what you saw today and you want more education, you would like maybe to bring this kind of education and maybe host it for some of your family or friends or group of coworkers, or maybe you own a business and you want this kind of education, we would like to know, would you like to bring ChappelWood University to your people? So we're going to launch this poll right here. And if you would like to
Good idea.
have us give you a call and we can talk about it. Let's host a class just for you and a few members of your family. Maybe they need some financial education. Maybe you've got some coworkers that you guys get together and you talk about, you know.
Everybody talks about
Yeah.
finances. I call it a golf course bragging rights.
That's
because
right.
Ben loved talking about it on the golf course.
Yeah,
It's amazing.
absolutely. Or maybe you just need, you want 30 minutes to get some questions answered. You know,
Yeah.
sometimes that's all that it is. An educational event doesn't have to be so formal. It can literally be a webinar like this where you
Just
get
ask questions.
you and 5 of your good friends and you just ask us any question you want to ask. So anyway, give us answer that question right there and we'll be happy to reach out to you. And if you are looking for some guidance, you need some help right now, you want to take advantage of that Gold Bucket Optimizer, this beautiful woman that you see right here, and I'm sure she's in the
Yeah.
office right next to us and she's rolling her eyes and she's probably thinking,
The
dear
lovely
God,
Shelley.
why do they do this to me? That's because we love you, Shelley. Give Shelley a call. And if you're looking for a Gold Bucket Optimizer, schedule an appointment, get some guidance over the phone, give us a call, 405-348-0909, or text the word gold to that same number and Shelley will be in touch with you. Financial Diva, it's your show. So how do you want to end today?
I want to say thank you for coordinating. Thank you to Adam. Thank you all for being here. Again, if you have any questions, you know, we're only a phone call away, a text away now. All you have to do is text us at 405-348-0909. Thank Allie. We really appreciate, look at that cute little couple right there.
That's right.
We appreciate her being here today so much. And my best advice is always, it's never going to change. Don't take advice from broke people, physically, financially, or spiritually. Stay healthy.
Thanks for joining us. We'll see you next time on Diva and Friends.
I hope you enjoyed it as much as I did.
That's right.
I always have fun.
Stay safe. We'll talk to you soon. Bye-bye.